there's no doubt the real estate market has been oscillating, making some changes, and kind of odd. And here's why that's happening. So between 2020 and 2022, the Fed dropped the federal funds rate. They dropped the federal funds rate down to 0%. The federal funds rate is where banks charge each other to send each other money overnight. The Federal Reserve also guaranteed they would buy all these mortgages that were originated. They had to stimulate the economy because of the lockdowns. So they dropped interest rates. So we're going to buy all of these mortgages. Those are considered mortgage-backed securities. They bought them at a very, very, very tight to negative cash flow. So they bought these things at like, under 60 basis points of profit. Any kind of refinance, they lose profitability, lose income on those mortgage-backed securities. Imagine you had a lemonade stand and you said, hey, I need to sell all these pieces of lemonade, and you had a guaranteed buyer. So let's say you originated it at $1, and then a buyer would buy them from you at 90 cents because they wanted the income coming from the lemonade in the future. That's what that means. When a refinance happens or a change, meaning that debt is then sold to somebody else, they lose out on that income. So what the Fed's not telling us, and this is what I firmly believe is why rates have not dropped, mortgage-backed securities buyers have really stalled out. So the Fed was buying all these mortgages, stimulate the economy, right? The economy stimulates very aggressively, which it did. Shelter inflation went up dramatically, 35, 40, 50% shelter inflation. Okay, that's what most people in real estate think the most about when they think mortgage rates. The less buyers of mortgage-backed securities, the more rates have to stay where they're at. Here's my assumption of the current market and mortgage rates and how they make sense and matter. Rates are not going to go down until the end of this year to early next. Here's why. On the Fed's balance sheet, they're holding all these securities. Imagine you're buying something you bought this lemonade at 90 cents. If you sell it now at 75 cents, you're managing a nasty more and more of a loss. So they cannot have refinances. The biggest buyer of these are banks, pension funds, mutual funds, and the Federal Reserve. You get hedge fund buyers in this, but for the most part, this is institutional capital that's buying these mortgage-backed securities, okay? They bought very healthy, but very thin margins. So mortgage-backed securities buyer is very similar to what I do when we do at Resolve. As a fix and flip buyer or a wholesaler, where you're buying below value. So let's say a property, let's use San Diego, for example. There's a big rule in San Diego real estate, in real estate investing, where you buy 70% of value. So let's say that's a very ethereal number. A lot of things can happen in there, but that's like the general rule of thumb you hear from all these podcasts or whatever. So let's say the property's going to be worth $1 million remodeled. You need to buy it at $700,000. That's like the basic numbers. Mortgage-backed securities, not much different. They need to buy things at about 125 basis points, which means 1.25% spread between their cost and profitability. It's almost like owning a rental, having cash flow. Mortgage-backed securities right now are at 1.6. That's the current yield spread. And there's no buyers at it. Federal Reserve's not buying a ton. Banks aren't buying a ton. And because of that, because everyone's scared of the refinances. They don't want to get refinanced and lose their position and not get enough cash flow. Cash flow is very, very important as an investor. That's everything. It's their MBS position that they're holding out on. They're telling you it's inflation, they got to get job control under control. That's all the window dressing. The harsh reality of this is their MBS holdings are in the trillions and trillions and trillions of dollars. The longer they hold, the more cash flow they get. Does that make sense? If they sell or rates go down, refinances start happening, they got to be able to unload these securities. There has to be other buyers of them. So in a roundabout way of saying, interest rates have to stay where they're at. They are not going to drop them. If they drop a quarter point, they lose refinance stuff. They have to go bigger and aggressive, but they have to wait longer. So here's what's going to happen. They're going to probably, towards the end of this year, in December, towards the beginning of 26, I think they need to go to mid-26, but here they're going to get political pressure. They're going to have to drop rates. They're going to drop rates by 1 to 2%. Federal funds rate. Okay, so 1 to 2%, you're going to see a federal funds rate drop, okay? Now, everyone thinks in real estate, oh, that means prices are going to go up. They're going to shoot up. Not exactly. What's going to happen is they're going to tick up just a little bit. You'll see them recently go up because sentiment will increase. You're gonna be like, oh, excuse me, values will go up. Here's what starts to happen. Here's what the Fed has to do, by the way, to balance out the housing market, because that's so out of hand. Once rates go down, which they will, because then you're gonna get more buyers of MBS, which means supply and demand. It's gonna drop the yield spread to a normal amount, which means it's gonna be more healthy buyers buying those mortgage-backed securities, which is going to help keep rates a little lower for a little bit longer, but it has to happen over like 8 to 12 months. So I presume a 1.5% to 2% drop next year. After that, the highest likelihood is going to be is the market will start to flatten out a little bit. You're going to have a lot more, because here's what happens when rates go down. It's not that people buy, people also want to sell at that point. So inventory will start to flood to the market. And that's what the housing market needs. It needs inventory. You need equal supply. I mean, and obviously we know there's a little bit housing supply and all those things. I'm not getting the niche of the markets. I'm talking general real estate investing world and how it operates. Is the same people who can look in the sell and buy are now going to come into the market. And because they're like, okay, I'm not changing my 3.5% for a 7%. I'm changing my 3.5% to a 5.25, 5.5. I can do that. It makes sense. I have enough equity to put down that kind of keeps my payments where it's at. Everyone's focused on payments and affordability. This is what's going to happen, folks. So strap on for another 2.5 to 3 years of a finicky market, extremely volatile for some people who aren't as experienced, but just hang on. And so the good news about this is the pros will start to rise, and cream will kind of rise to the top as the market tends to oscillate, and you'll start to see this happen. The agents will start to do better, brokers start to do better, but there has to be a balance in the market, and that's what's going to happen. So don't just think rates going down increases values. It increases inventory, which keeps still values where they're kind of at. They can't tick up too much because affordability is going to rear its ugly head. That was what will happen. Let's jam.